Hey traders, Raghee here. Great to see everyone. Welcome to Charts and Coffee. Happy Friday. Happy OpX Friday. We have our options expiration session kicking off today, which is to say today is, if you've never traded through OpX before, I do treat it as what I call a caution day. So there's a specific event that's sort of hanging over the session that can create price action that's outside the norm. Most of us do well when things, most of us, right, do well when things are within the norm. So about 68% probability of price movement, more predictable support and resistance, etc. But today is really about the expiration of the most number of options worthless. That's the guiding principle of today. It has nothing to do with what happened yesterday. It has nothing to do with what will likely happen on Monday. It's a little island in terms of a session unto itself. And because we have these September 20 options, a third Friday of the month, that's typically the expiration part of the chain that has the most open interest. So open interest is the number of contracts that have been wrote and bought, right? So there's a contract for an option, a particular strike sitting there, and it's going to expire. Now, when that expires, there's folks who, I like to buy options. There's folks who say, oh, the option is either in the money, at the money, out of the money, whatever. And there's folks who wrote it. They're going to say, oh, I lost money on this or whatever. So that's why it's all about size. And again, I don't really subscribe to the specificity. So you might say, Rog, what does this have to do with max pain? I don't really subscribe to the max pain thing of where there's a single level that would represent where a particular stock or ETF should close in order to render the most number of options worthless. You'll see there's different increments. So rather than think about it as a singular level, which I actually think it's helpful, but it's not as accurate as looking at what side of the chain has the most options, what's the general direction of the trend on the chart. I would focus on the daily. And lastly, what are all the different levels of, say, pick the top 3 strikes with the most open interest. And you'll see that's going to help you a whole lot better with navigating through OpX. Now, as I'm navigating through OpX, for example, I've got a long position that we built in the Russell via IWM calls. Now, the idea that IWM could pull back a little bit today is absolutely not only expected. I would always expect that in the life cycle of a trade, not every day is going to move in my favor, but it doesn't mean that I'm going to add on the days that don't. It just simply means there's a fixed amount of risk that I'm willing to take. And if I enter my trade in the most ideal way possible, I can be in a position where I can sit through some of that heat. And so we've got 222 calls that we picked up, and I'll give you the price level just so you get an idea of what I'm talking about. I picked up these 22 calls. They're the October 18 calls, and we triggered these. Now, this is the important part. We triggered these down at 222.35. So you can see where we are now. And I triggered these at 222, which is way down. It's not even on this 5-minute chart. And so it gives me a lot of wiggle today in order to handle it. The other thing that I've done is I'm going to jump on over to the option chain on IWM, and I'm going to look at the September 20. I'm not looking at the October 18 expiration that I've got. I'm going to go take a look at the September 20 and see where the size is. Now, there is a ton of size on both sides of the chain, but most of it is on the call side because we've been moving higher on the Russell. So sometimes it's not as easy as other times to determine, but 220 is a huge, there's 97,000 contracts there. Do I actually think we're going to down to 220? I actually don't. But there's a lot of expectation that between 224 and 225, I can run into some resistance because when I look at, again, in order of proximity around price, my most liquidity is at number 1, 220, number two, 225, and number three, 224. Now, yeah, there's a huge zone up at 230, but I don't expect us to go up there either. Although I'm fine with it if it were to. So notice I'm not reducing it to one level. I'm looking at the different levels. And this is the kind of thing that we do in the mastery on OpEx Friday. And again, specific to the third Friday of the month. All right. So what I want to do after that is remember that if I'm going to buy anything as a swing entry, right, the consequence of today is going to be that gravitational pull to rendering the most number of contracts worthless. So I'm going to think about that, right? As a consequence, I will think about whether I want to enter the trade today or maybe it's going to be next week. All right. Another thing I want to make sure I mention to everybody, because I've been very much a vocal, outspoken proponent of defensives. And we've been doing that since, frankly, end of July. We were in defensives through almost the entirety of August, which is why when we had the big pullback based on the yen and the carry, we didn't have any significant drawdown at all. In fact, our positions were aided by that concern in the broader averages because staples are a defensive, utilities are a defensive. So that worked out really well in August, and we carried that over into easily the first 2 weeks of September. But since we have such clarity from Jerome Powell and the 50 basis point cut, and essentially the promise of much more to come, Jerome really I have to give him a lot of credit. He did a great job with the 50 basis point cut to eliminate oh my gosh, the Fed is behind the curve. In fact, he kind of presented it as this is to ensure that we don't fall behind the curve. He did a great job, great salesmanship on his part during the press conference on Wednesday. So they're just letting us know that we are active, we want to stay ahead of the curve, and there are far more rate cuts to come. This is not the time to think defensively, not to me. So one of the things that we've done this week is we're shifting away from a lot of the things that we had been trading so actively. In fact, going into the FOMC, healthcare, we actually closed our Johnson & Johnson at a nice 2x win. We still have industrials, financials, and then now we have the Russell. So I'm starting to take on more of a risk appetite. So the latecomers to the defensive party, be careful with that, because that's been a active, almost 2-month long outperformer. If you take a look and if you know how to build a fluid watch list and you know how to find those relative outperformers, you'll see they're dropping down by the wayside. I mentioned this on Tuesday, and that we're starting to see a little bit more risk appetite coming in based on laggards through September being bought the day before the Federal Reserve. That's not bearish, gang, and that's not risk aversion. So those are things that I'm making adjustments on. So this week and going into next will likely be a pretty significant revision, update of the watch list that we've been really very much benefiting from for the past almost 2 months. But it's going to be probably very different going into the end of the year. So keep in mind, if you've been listening to the show for a while, it's not the Procter & Gamble's and the utilities, although they'll probably be fine, but they're likely not going to outperform some of the other more risk appetite type positions. And then we have end of quarter at the end of this month. So it's going to get very, very interesting. All right. Next up is, what are our questions here? Let's get to it. As always, if you want to check out what we're doing, if you're struggling with your watch list building, if you said, Rog, you've shared with us a number of times and the trades that you've taken this month, and yes, I will continue to do so. I wasn't that active through the month of September. Where are these trades coming from? These trades are coming from relative outperformers. These are actually, I need to add Johnson & Johnson to this list. These are the closed trades for simply September. I think we're coming up on 15 closed swings. And I was mentioning yesterday that we still have these positions open. There's my new position in the IWM. Now, if you're struggling with building that watch list, if you're struggling with that activity on the swings, if you're struggling with your position sizing or your stop loss placement, if you're struggling to find consistency in your account growth, including small account growth, check next Tuesday. It's coming up. I can't believe it. In just about 4 days on Tuesday, coming Tuesday at 8 p.m., we're going to have a webinar. I'm going to walk you through the kinds of trades that we've been taking through August, through September, and the consistency in that account growth that we've been able to have under conditions that are far less about trends and a lot more about chop. And yet we're able to find trends and we're able to follow them. So we'll talk a lot about that on Tuesday. Cannot wait. All right. Any thoughts on MU? So MU is still a narrative that I would put firmly in the bearish category. I mean, look at MU. And this is what I mean about there are a lot of interesting names out there, and I'm by no means saying that MU is not capable of bouncing. Again, I don't know if you're bullish or bearish, Bob. That's the first thing, right? If you and I are going to talk about a symbol, Bob, the first thing I'm going to tell you is what time frame I'm looking at, what direction I'm looking to trade it in, and then the levels will take on the context of wanting to be long or short. This is a bearish symbol for me, and I really wouldn't put it on the watch list, especially considering I'm starting to see a lot more strength in the tech side of things and in the NASDAQ. Now, the thing with MU or any laggard in a sector is it could play catch up, but that's seldom the way that I would treat it. So probably not the kind of symbol that would fall on the watch list of that kind of account growth for me, but I would keep an eye on say the 85-20 area if you are bullish, but I don't actually know. I'm assuming you are, but I wouldn't be putting this high on my watch list. All right, next up, Seamus asks, you mean to say that the TV analysts might be wrong with the Fed preparing for a recession? Oh yeah, you know, I've done the TV thing. I've done it, and you know, you get a PR agent, and you could do it too. It doesn't take much to be on TV, I will tell you, but we do give it a lot of credence, don't we? Yes, they might be wrong. Yeah, TV. Look, it's like saying the person calling the ball game is the same person who can go and play. It's very rare, although some analysts, I imagine, might have some experience with active trading. But you know what the funny thing is? I think the hardest thing about listening to television is kind of the conversation about the symbol and the direction and the time frame and the time horizon that we focus on in the mastery or even in these shows, which is what's my direction? How long do I expect it to go in that direction? And because time frame and time horizon are never even really discussed, and that you've got a investment channel masquerading around as an active trading channel, it really confuses a lot of the retail public, right? Because if there really were investing conversations, it would be a very different conversation. It would be more like a 2-hour show than a 24-hour cable station. And that's any of them. So the challenge for the retail market participant is, what am I? Am I an investor? Am I a short-term active investor? Am I a long-term active investor? Am I a short-term trader? Am I a long-term trader? And so, you know, it's kind of important because that's going to then be the way in which we look at the symbols we trade and the way that we trade them. So yeah, it's really interesting. It's really interesting how much credence we put on the folks on television, because, you know, I'm sure they can tell us the entire investment and trading thesis in the 90 seconds that they have in front of the camera. I always used to feel that way when I was doing an interview, thinking there's no way I could possibly share everything that I need to share in a quick soundbite conversation. Sad but true. All right, so let's get to what's going on with, again, I mentioned I'm long the Russell. And by the way, gang, you know, analysis, I really want to normalize sharing trading positions, not analysis. If you know that I'm long the Russell, if you know that I'm long financials, if you know that I'm long industrials, you're going to think to yourself, Rag is kind of bullish. And she's bullish in these places that are part of the broader averages, or are actually one of the indices, the broader averages. And so there's nothing defensive about my book anymore. In fact, we've wound down all those positions in the past week or so. And most of them had very, very nice gains. So the challenge is going to be for most traders in this stage of the year is, how can you shift gears on your watch list? And do you have a mechanism by which you, A, observe its time, and B, can look at something like, for me, Pepsi, Coke, these are very big trades from last month. Staples, Can I let those go? Or am I going to be like darn near every SMCI trader from earlier this year waiting for the greatness to return? And that's just a tragic thing. I see it all the time. This narrative is done. It was done back in the end of March. But how many folks are still glomming onto it? Yes. And that's the problem, right? When we find something we love and it's our favorite thing in the whole wide world, and it was very good to us once upon a time, it's really hard to let it go sometimes, especially if recently recency bias is a thing. It was very good to us. Coke was exceedingly good to us, but it's really time for me to let it go. Things like Staples and Procter and Gamble were very good to us, right? But it's time to let it go. So be careful about some of these. I'm not saying they can't keep going up, but they're likely not going to be where those trends and that consistent account growth is likely going to be coming from. All right. Question on the long bond. Sure. Patrick, the long bond, I will tell you right now, straight up, is confounding me. I have two challenges here. It's mostly bullish, so I don't want to be short or long puts on TLT. It's not a trend any longer, so it doesn't have the swagger that it has, say, for about a week between the 9th and the 16th of this month. It's a little tricky to trade bonds because the rate cut that we just got Wednesday was factored in 3 months ago. Bonds already said Jerome's going to cut sometime later this year, likely Q4, and bonds like to front run monetary policy by typically about 3, sometimes as much as 6 months. So what we're seeing now, my experience of bonds, is not reflecting the next 2 rate cuts we're going to get at the November and December meeting of a quarter point. What it does say when I look at this is the uncertainty about what happens in Q1 of next year. Bonds are saying, okay, we already expected this cut. We already discounted it. It's already happened. Now, what do we expect, say, in January and February of next year? Can Jerome continue to cut a quarter point at every one of these meetings? And that's the hesitancy that I see in bonds. So I'm going to leave it alone for now, Patrick. Now, that doesn't mean that another symbol sort of related to bonds may not be interesting. So this is where watch list building is so important. It's a game of trade this, not that. I'm going to leave bonds alone. I'm going to continue to trade gold. We've been very active in gold for weeks. We've been active in gold miners, Newmont mining, and I want to continue to press our advantage in what is a really bullish uptrend here. And that's another symbol that I would very much like to get back into. So sometimes it's just a matter of, when I'm looking at bonds, I'm thinking about real yields, real interest rates. And that combination is the rate of inflation, the shorter end of the yield curve. And that actually gives gold a lot of clarity. So I think gold might be the best way to look at the interest rate narrative right now, Patrick. That's the way I'm looking at it. It's played out pretty darn well. All right. Next up is, bear with me, Ren asked about TSLL. Okay. I don't play the directions very much, Ren. So the way I would look at something like TSLL, right? So for those of you that don't know what it is, this is a Tesla. It's a Tesla 3X, right, Ren? So I'm going to look at just Tesla, right? So TSLL is just really a play on TSLA. TSLA is breaking out, which is cool, which is fine. I don't play Tesla, Ren. I'll tell you straight up, it's not a symbol that I typically like to trade because when I look at the way it moves in relation to consumer discretionary and the NASDAQ, where it's quite heavily weighted, and the S&P, it tends to do its own thing. But here's what I'll tell you, Ren. When the candles are red, focus on puts. When the candles are neutral, sit on your hands. When the candles are green, and consistently green, maybe at least 2 or 3 green candles in a row, and these are top tier candles, then I would focus on long calls. So that would be the last time the long call was valid, would likely be either the 11th or the 18th of this month. And I'm not going to chase this higher. So that's where we are with the morning. All right. As always, gang, thank you so much for being here for Charts and Coffee. I will see you all on Sunday, 6 p.m. for the top tier outlook. All right. Be good to each other, gang.